Dollar cost averaging is a simple technique that entails investing a fixed amount of money in the same fund or stock at regular intervals over a long period of time. It is investing a fixed amount of money into a particular investment at regular intervals, typically monthly or quarterly. The strategy, with its potential to mitigate timing risk, is most often employed for riskier investments such as stocks and mutual funds, as opposed to bonds or real estate. If you have a 401k retirement plan, you're already using this strategy. Make no mistake, dollar cost averaging is a strategy, and it's one that can get results that are as good or better than aiming to buy low and sell high. As many experts will tell you, nobody can time the market. How to invest using dollar cost averaging. The strategy couldn't be simpler. Invest the same amount of money in the same stock or mutual fund at regular intervals, say monthly. Ignore the fluctuations in the price of your investment. Whether it's up or down, you're putting the same amount of money into it. This can even be done automatically by reinvesting a dividend payment back into the stock itself. The number of shares purchased each month will vary depending on the share price of the investment at the time of the purchase. When the share value rises, your money will buy fewer shares per dollar invested. When the share price is down, your money will get you more shares. Over time, the average cost per share you spend should compare quite favorably with the price you would have paid if you had tried to time it. Rewards of dollar cost averaging. In the long run, this is a highly strategic way to invest. Since you're buying more shares when the cost is low, you're reducing your average cost per share over time. Dollar cost averaging is particularly attractive to new investors just starting out. It's a way to slowly but surely build wealth, even if you're starting out with a small stake. Example of dollar cost averaging. For example, assume an investor deposits $1,000 on the first of each month into mutual funds, beginning in January. Like any investment, this fund bounces around in price from month to month. The investor keeps steadily putting $1,000 into the fund on the first of each month, while the number of shares that amount of money buys varies. In January, $1,000 bought 50 shares. In February, it bought 62.5 shares. In March, it bought 83.3 shares. In April, it was 58.2 shares. And in May, it was 43.48 shares. Just 5 months after beginning to contribute to the fund, the investor owns 298.14 shares of the mutual fund. The investment of $5,000 has turned into $6.857. 11. The average price of those shares is $16.77. Based on the current price of the shares, the investment of $5,000 has turned into $6,857.11. If the investor had spent the entire $5,000 at once at any time during this period, the total profit might be higher or lower. But by staggering the purchases, the risk of the investment has been greatly reduced. Dollar cost averaging is a less risky way to obtain a favorable price per share. Why use mutual funds? When it comes to using the dollar cost averaging strategy, there may be no better investment vehicle than the no-load mutual fund. The structure of these mutual funds, which are bought and sold without commission fees, could almost have been designed with dollar cost averaging in mind. The expense ratio that mutual fund investors pay is a fixed percentage of the total contribution. That percentage takes the same relative bite out of a $25 investment or regular installment amount as it would out of a $250 or $2,500 lump sum investment. For example, if you made a $25 installment payment in a mutual fund that charges a 20 basis point expense ratio, you would pay a fee of $0.05, which amounts to 0.2%. For a $250 lump sum investment in the same fund, you would pay $0.50, or 0.2%. Several fund options for dollar cost averaging. Still, the availability of no-load mutual funds, which by definition do not charge transaction fees, combined with their low minimum investment requirements, offers access to investing to almost everyone. In fact, many mutual funds waive required minimums for investors who set up automatic contribution plans, the plans that put dollar cost averaging into action. To really cut the costs, you might consider index funds or exchange-traded funds, ETFs. These funds are not actively managed and are built to parallel the performance of a particular index. Since there are no management fees involved, the costs are a fraction of a percentage. A long-term strategy. Regardless of the amount you have to invest, Dollar cost averaging is a long-term strategy. While the financial markets are in a constant state of flux over long periods of time, most stocks tend to move in the same general direction, swept along by larger currents in the economy. A bear market or a bull market can last for months or even years. That reduces the value of dollar cost averaging as a short-term strategy. In addition, mutual funds and even individual stocks don't, as a general rule, change in value drastically from month to month. You have to keep your investment going through bad and good times to see the real value of dollar cost averaging. Over time, your assets will reflect both the premium prices of a bull market and the discounts of a bear market. Mitigate timing risk and emotional decision-making. The fear of entering the market at the wrong time can lead to inaction or hasty decisions. How to calculate dollar cost averaging. Let's say that an investor named Mr. Lee invests 1,000 Singapore dollars per quarter for 1 year into the SPDR Straits Times Index ETF. Now the price of the ETF may change each month, but the amount Joe invests never changes. Theoretically speaking, as long as the ETF increases in price over that time period, Mr. Lee will have successfully used dollar cost averaging to see a positive return on his investment. Build long-term wealth even if you're a newbie investor. Most new investors do not have large sums to invest and don't always know where to begin. Typically, as their earning power increases, they will have spare cash each month to allocate to their investment portfolio. Dollar cost averaging is thus the ideal strategy for new investors looking to build a long-term portfolio. It also provides for a very hands-off approach which can be ideal for the inexperienced investor. That said, while dollar cost averaging is a simple strategy, there are a few caveats to keep in mind before you jump in. Number 1. You must have the discipline to stick to it. When the market is going down, you may feel very tempted to sell. That's why, despite the adage buy low, sell high, many investors end up doing the opposite or not put in your regular investment. However, that would nullify the strategy's basic idea of buying more of an investment when the market falls. Following this strategy also means that you can't fluctuate your position based on the current share price of your investment in terms of increasing the amount you spend on the purchase of more shares when the price is lower and less when it is higher. Conversely, you may feel exuberant and want to invest more in a rising market, but you may end up paying a higher average price or buying at the top of the market, which is what this strategy is designed to avoid. Number 2. You still must choose the right investment. Dollar cost averaging does not spare you the work of choosing an appropriate asset to invest in. Dollar cost averaging into a bad investment is still a bad investment. Many investors use dollar cost averaging as part of a passive investment strategy, meaning they invest in passively managed index funds that track an entire market. This reduces the amount of personal due diligence that's required from them compared to researching specific stocks or actively managed mutual funds. Number 3. Watch out for transaction costs. Regular and frequent investments mean more transactions, which might mean more costs eating into your returns. This is especially true for fixed transaction costs, such as a brokerage that charges you 10 Singapore dollars for every transaction. If you are just starting out and only investing 500 Singapore dollars a month, that represents a 2% transaction fee. Hence, many investors who use dollar cost averaging prefer to stick to low-cost passively managed index funds, which charge a low percentage-based fee instead. Number 4. You may end up with fewer shares than you think. The share price of an investment may rise over time, which means that you may be getting fewer and fewer new shares with each investment. This was all for today. I hope this video helped you. Don't forget to like and subscribe to my channel for watching more videos like this.